Okay, I got the record on, so I guess this is who's going to join today. Remind your colleagues to come to class, of course. Hester is gone for the next 3 weeks on vacation. She gets back, I think, on October 28th. So if you have administrative issues, email them to me, and I will forward them to the correct party here at the law school. However, if you know who the correct party is, send it directly to them. So if you have business office, send it to business office. If it's financial aid, to the library, send to the library, and so on. All technology issues will be sent to help@tjsl.edu. Often people are sending me emails on Westlaw help or Mega Meeting help, and I rarely get to read my emails before 8 or 9 at night. So you've already lost a day by the time I've seen them. Plus, all I'm doing is, of course, forwarding them on to the respective parties. So if you want to save yourself a day in response time, just send it directly to help@tjsl.edu. For those of you who have twin problems, because one of the students couldn't get into their transfer pricing materials, you need to watch the orientation videos that are in YouTube also, for short versions, on whom to contact at Westlaw for support. Everyone should see in the center of my screen the Westlaw support window. And so you can email or click on their names. And when you click on their names, it will give you their telephone numbers or the general 800 number. So I'll go ahead and do that just to, since 2 or 3 people in the last week had twin issues. So if you have research issues, it's the first number. If you have twin issues, it's the same first number as the second number. Call, or you can always email Christy, who will, with twin, all she'll do is forward your question over to the twin staff. You also have your student reps down below, Derek and Jerry. Okay, we're going to start off class. Alan DeCoker cannot be here because it's the Jewish high holiday, and so while he is repenting and finishing up service at Temple, we're going to be covering the exam for both courses. First we'll go to, let's see, tax planning. First we're going to go to the tax treaties exam requirements. In the tax treaty exam, it's due November 5th, which is approximately 4 weeks. There won't be any extensions granted on that. Everyone had plenty of time, so you don't have to turn it in exactly on time. We always are lax about it with the students, but we are enforcing that everyone loses a letter grade. So you can turn it in late, but you automatically lose a letter grade. Everyone knows the rules. The examination link, I click on final examination and due dates. It's been posted since the 21st. Plenty of time. You can see it there. And the first part, it's a 2-part final. So the first part, due by November 5th, requires that you have a minimum 3,000-word study guide, and it must include 9 U.S. cases to provide analysis of an issue. You must attach a Pathfinder and a slide presentation. Everybody who submits on time is going to be given the opportunity to present to the class. That's not a chore. That's not an assignment. That's an opportunity. We were having discussions yesterday with Ernst and Deloitte and some of the big firms, and because of the cost of flights and the lack of flights and other issues, time out of the office, client billing has been an economic downturn. People are not taking as many trips. They are speaking with their clients and doing client presentations by video conference, i.e. by mega meetings, by live meetings, and so forth. If you're not competent to present a proposal via mega meeting and video conference, then you're not going to be able to solicit client work. You're going to have a very difficult time in the corporate world. For the individual world, it'll be different. That depends, of course, on the person being presented to. But in the corporate world, you're going to have a very hard time. They're requiring the skill sets now amongst their practitioners, counselors, staff, and so forth. Now, I'm talking tax treaties at the moment, but for principles of international tax, for principles of international tax, Bill Andrews is the instructor. I would have set a later time frame regardless. I've looked at their forums, and they've set earlier time frames for people. So if you've been given by Bill Andrews Module 3 due on October 13th, and that's when it's due. In tax treaty, we just reduce a letter grade for being late. Bill Andrews has his own policy. He gives Fs in his course. So if you turn it in late, he may just give you an F for that assignment. You'll have to speak with him directly on that. For people who want advice on potential topics, if you have not responded below, obviously you have Miguel, because we're looking at Article 26 of the Model Convention, your response. But for people who want advice on topics, we have 2 different pre-recorded lectures on finding topics. And Part 1 and Part 2 here in the assignment link. Does the rule apply to those who enter the class in the second week? Absolutely, 100%. If you entered it in the 4th week, it's the same rule. This was posted September 21st. Everybody was in the class by September 21st. Regardless, everyone has 4 weeks from today, it being October 9th, to get this assignment in, being due on November 5th. Again, you can be late, but you automatically lose a letter grade. And you can't do a presentation because we have to schedule the presentations between November 5th and December 15th, and there's a very heavy lecture schedule, which we can discuss now also. And finally, I see other people showing up in class now. The weekly assignments. We don't have weekly assignments in tax treaties per se. You must be talking about Bill's class again, international tax. You'll have to refer to him directly on the weekly assignments. Nicole, are you talking about international taxation or tax treaties? You must be talking about international taxation, because tax treaties, we only have discussion questions. What questions are you talking about? I'm talking, in Module 2, we have discussion questions, by example. Well, the module questions, if you look at your screen, it'll be there in a moment. I'm looking at Module 2, by example, the last day being October 4th. It's obviously passed. All that means is the instructor is not going to be checking the module anymore. Remember, I'm not the instructor for the class. I'm just lecturing. The instructor, Alan DeCoker, for this portion, will not be checking or responding to the questions anymore. In the orientation class, it clearly states every module is open for 2 weeks and 2 weeks only. So if we go to the orientation class, orientation class, we'll see under the protocol that when a module's open, after 2 weeks of that module being open, and some teachers post it like I have done for DeCoker here, last day October 12th for Module 3. That's 2 weeks later, so that's in 3 days from when it was open. And then Module 5 will open. We don't have a Module 4 for this course. It's blended in with your 1 through 3. And so that 2 week period, once it expires, you can still put your materials in there, but the professors just aren't going to go back and check. It's too difficult for people, including the students, to keep having to go back through 100 plus responses by the time you're halfway through a class. There is a drop box certainly for principals here in Treaties. There's the drop box for submitting your examination part 1, November 5th. And for putting your final one up on December 5th, the final article, which hopefully everyone will be able to use in their professional life to publish that article in respective magazines or newsletters. And these were actually set up by DeCoker. So if you have questions on when your assignments are due, email the professor in the class or address them under admin queries with them. In this case, you'd go to email options and you'd email DeCoker. I cannot use the assignment Dropbox at all. It just keeps on sending it back to me. I hope that will be sorted out soon. Well, hopefully you've told Twin if that's the case. If you're having a technology issue with Twin, I haven't heard that yet. Then you need to email or call or speak with Westlaw. If you're not able to access the sound on MegaMeeting, again, you'll need to call or email MegaMeeting directly, or do live chat with them on www.megameeting.com. The syllabus for both classes sets out the lecture schedule. So just to clarify where we're going with the lectures, DeCoker's kicking in next week's lectures, and he'll do both of those. The following week in the principles course, I've already put it in the calendar for him. The following week in the principles course, Bill Andrews sent me an email yesterday that said that he was teaching on Sunday, on the 12th and the 19th, 3 p.m. Pacific time, 6 p.m. East Coast time. So anybody who's in that course, I assume that you've been communicating with your instructor on those times. That's so like Wendy Perez can participate and the people who can't do weekdays. And then you have your other lectures already there. You have recorded lectures, live lectures, and so forth. He's the instructor and grading that course, So whatever he says goes. He has to have a final examination. So instead of November 5th being the deadline, he's given the students alternative deadlines. So if I look under final examination, I assume I'm going to see, an admin form. So every student has from him their due date. If you don't, obviously you'll need to email and contact with him. Secondly, yes, I see it. So he has all the names and the dates of the presentations in front of us. Got it. Okay, so everyone has their dates here on the screen. You'll see it in a moment, but that's under there you are. No, that's Wayne. Okay. Okay, so I've highlighted those so everyone sees those dates. I assume that the Sunday lectures by Bill Andrews are, he's going to discuss that further with y'all. Okay, I'm going to close out the, does anyone else have admin questions on the course, procedural questions? On Tuesday we covered the lecture syllabus for recorded lectures and so forth that are already been recorded, or perhaps live webinars like we had last Friday, or was it Monday on IFRS? It was Monday, the 2-hour webinar. No other questions? Okay. We're going to proceed on to the second sentence of paragraph 1 of Article 4, which means that I'll go to my proxy server and pop open Tax Analysts, as we do each lecture time. I'll point out some new databases. I saw Checkpoint was up here. There it is. For those of you who saw the lecture, and it was recorded and it is under your recorded lectures, International Tax Expert and Compliance Expert, those toolkits, very expensive stuff, very cool software. International Tax Expert is the software that calculates all possible routes and the tax calculations from one country to another country with as many intermediary countries as you want to put in there. Tax treaties and not tax treaties taken into consideration. We have bought probably too many accesses, but anyway, plenty of access. There are the 6 usernames and passwords, and then those will change every few weeks. So regardless, when you come to the proxy server, you'll find these on your left-hand side. Sorry, you'll find these on your right-hand side. We're adding, within the next week, Offshore Red, most importantly, Trust and Trustees by Oxford University Press, which covers all the case law internationally, generally absent the U.S. The U.S. is well covered in Lexis, Westlaw, and the other services. So Trust and Trustees covers non-U.S. case law on international trusts and so forth. And it's kind of like the Butterworth service for offshore tax cases and the international tax cases, except it's by Oxford. So the link will be up here, and we have a few other databases that have that are being added also that we've acquired. Okay, so I go down to Tax Analysts. We're worldwide tax treaties. We've already been through the lecture of reading your daily newsletters like Finland, Netherlands, Antilles, Savings Tax Agreement published. Bangladesh and Myanmar signed a tax treaty. I'm sure they have a lot of use for that. Estonia and Montserrat Savings Tax Agreement published. Okay. We're going to go to our model conventions, and we're going to pop open the OECD, and we're going to go straight to Article 4. Our second sentence of Article 4 states, I've highlighted it. I'm going to wait till it's on your student screen. At least it's not on mine yet. It's slow. How much latency do I have? Do people see the highlighted second sentence of Article 4 yet? If you see it, put yes in there. You see it on your screen? Huh. I don't know why my computer's so slow on this side. No, other people can't see it. Strange. Okay. Here it is on my student screen, I think. Yeah, now, okay. I think everyone sees it. This term, however, does not include any person. Person has a wide meaning. We know it means individuals, companies, and in some treaties, trusts, REITs, and other stuff. Does not include any person who is liable to tax. Liable to tax. We looked at that concept already. Liable to tax. Sometimes liable to tax means tax is actually imposed. Sometimes it means, like with a tax-exempt company, depending on the country, sometimes it means, like with a tax-exempt company or entity, that it is merely that if the government wanted to impose tax, it could impose tax. It has fiscal jurisdiction. So sometimes liable to tax means fiscal jurisdiction. Sometimes liable to tax means it is a taxable company. If everyone understands the difference, that's an important difference. And it has made a tremendous amount of planning opportunities in certain treaties. So sometimes liable to tax means fiscal jurisdiction. Sometimes it means tax actually imposed. Okay, so any person, wide meaning, individuals, companies, potentially trust partnerships, REITs, and all the other kind of pension funds and things out there, is liable to tax, meaning fiscal jurisdiction or actually subject to tax, or even taxes applied in that state. So we're talking as the state is defined by its territorial boundaries or by the boundaries further expanded upon in the treaty under the scope of application of the treaty. By example, U.S. Virgin Islands for U.S. tax treaties. Puerto Rico, Guam, are they covered? You have to look at the treaty. In respect only of income from sources in that state or capital situated therein. This term, however, does not include this term, Article 4, residency, the definition of resident, the definition of who may take advantage of the tax treaty. Under Article 1, does the treaty apply to? To residents only, persons who are resident. Residents only. What is a resident? Resident is, first sentence, which we've gone through. What is not a resident? What is specifically excluded from residency? If you're only taxable on sources in that state or capital situated therein. Well, what does that mean? So let's take the simple example. I have a Dutch company. The Dutch company has a branch in the United States. Let's say an LLC. And the LLC has a business taxable activity. It has met the threshold of taxability in Canada. Now, let's approach it from two perspectives. Number one, the LLC is a pass-through. It is transparent for purposes of fiscal jurisdiction, i.e., the United States does not exercise fiscal jurisdiction on our LLC. In that case, is our LLC a person? Yes, it's a company. Is it liable to tax in the United States? The answer would be clearly no. It's liable to tax. It's a see-through. It's transparent. The United States, it doesn't file a tax form, so you don't go past it. However, for a fact, I know a practitioner who sometimes lectures in this program who is using U.S. tax treaties with Sweden, doing something very similar to this. So instead of Canada, it was Sweden. And Sweden was recognizing that the LLC, transparent as it may be, was resident for U.S. purposes. Because the LLC, the United States could tax it if it wanted. It could tax, but this gets us into the second part of the sentence, which is where we're going. It could certainly tax any income that the LLC produced in the United States. But that would seem to fall afoul of the second sentence. Regardless, that planner, it worked for him. I never quite understood the whys of the hows, only that the Swedish didn't understand the LLC was transparent. But regardless, the LLC could not get a tax residency certificate. Magic words. Tax residency certificate. So, how do I exercise my protection under the treaty? We kind of briefly spoke about that on Tuesday, talking about who your rights were with, if you had a tax issue, and we had a little diagonal right and a horizontal right, and vertical rights. Vertical rights between a taxpayer country, and then diagonal was more relevant, and we had horizontal rights between states, but they were rarely used, but in the competent authority situation, allowing them to talk to each other, or information exchange, tax collection, later issues. How does our LLC tell Canada not to withhold, i.e., a taxpayer in Canada who wants to pay income to the LLC, not to withhold on the income, or the LLC needs to tell the Canadian government that it is not going to be filing a branch or permanent establishment tax return, because maybe it falls in the permanent establishment exceptions to be covered next week. Generally speaking, you have something called a tax residency certificate, which means that the country that you're claiming the protection of its treaty, in this case the United States, the revenue can issue you a piece of paper. Now, this is not used by all countries. It's just that many countries do have, if you're going to file, or if you're not going to file because of a tax treaty-based position, you'll have a tax residency certificate to back that up. That may just be your tax filing, your actual tax forms filed in the other country. It may be like in the case of India with Mauritius, you had to have an actual stamped certificate from Mauritius, sort of gold seal on it, and you'd give it to the Indian authorities and it would say tax resident in Mauritius under Article 4. So we're on the second part of our second sentence, only of income in the sources of that state. And it would seem that our LLC, it certainly can't get a tax residency certificate if it's a pass-through because it doesn't file a tax return. Number two, if it's not a pass-through and it is taxable, well then it's taxable as a corporation, and then clearly is the United States taxes all of its taxes worldwide income, it would have a tax return that it could show the taxpayer who needs this certificate so that the taxpayer doesn't withhold in the other country, this case being Canadian. Now, where I want to go with this is, what if we erase the United States and we put Hong Kong, because Hong Kong now has tax treaties. So we're no longer with the United States. And we put Hong Kong here. And instead of Canada, we now put, let's go look at Hong Kong, who it has treaties with. We'll put Belgium. I know it has a treaty with Belgium. We could do the same with Singapore. And why do I bring up these countries? Malaysia, because they have source-based taxation, which we've discussed previously. They do not tax worldwide income of their taxable persons. They only tax sources from within their state. They're within the territory, arising from the territory, or deemed sources that the law deems, and we've discussed that maybe 5 weeks ago in the lectures, what that means. So I'm going to let's see if this will work. I'm going to open a new window with my treaties. Scroll down to Hong Kong. And let us pop open Belgium, Hong Kong. So I'm opening up the Belgium-Hong Kong Treaty. 2003 Income and Capital Tax Agreement between Belgium and Hong Kong. I'll go ahead and make the little squiggly lines disappear from the screen so you can better read it. What we're going to do is go look at how they've addressed Article 4. Now, first of all, just like when we discussed Taiwan, Hong Kong is not a state. Hong Kong is a province, a region of China, Special Administrative Region, SAR. For those of you who are in the China tax class, I'm sure you discussed it extensively. Hong Kong cannot be in a tax treaty. China can be in a tax treaty. Only states can enter into treaties. Taiwan is not a state. So Taiwan can enter into something other than a treaty. Taiwan isn't going to like it if the People's Republic of China enter into a treaty with Taiwan for Taiwan. So Taiwan enters into understandings, agreements, other kind of contractual documents. Anyway, they have the same effect as a double tax agreement. Some countries won't enter into double tax agreements with Taiwan, though, because they don't want to anger China. Recognizes the authority of the People's Republic, especially since there's a division of troops sitting in Hong Kong, which sometimes angers the Hong Kongese. But regardless, so China treats Hong Kong pretty well, and has opened up a tax treaty with obviously Hong Kong wanted it, with Belgium. So we scroll down. Is Taiwan not a state just for certain countries or all around? Taiwan is actually recognized. Taiwan in and of itself is not a state, no. Taiwan is recognized as China by a few countries. Dominica, I think Nevis, it's a few Caribbean states. I can't think of anybody else. I mean, most people, the only reason you recognize Taiwan because they give you a lot of money. So the poor Caribbean islands who don't care about their international relations with China, they're not poor, but they're Caribbean islands. They say, hey, if Taiwan comes along and says it's going to invest $10 million, that's all they need to build an airport, then they recognize Taiwan. And I don't think China really cares, because it's hard to find them on a map. Not being derogatory toward those islands, it's just practically, from the Chinese point of view, if the island of Dominica doesn't recognize the People's Republic of China, I don't think anyone in the People's Republic loses a night of sleep. Now, they'd be very upset if Malaysia decided to recognize Taiwan. That would not be cool, and then they would have a break of relations. I don't care which way it goes. I don't have a political opinion on it. It's just a practical reality. Taiwan has a lot of money and a lot of reserves built up, so it's a very interesting country, not just from a business and export perspective, but from an investment perspective, and it investing outward. There's a lot of planning opportunities, and a lot of law firms have a Taiwan desk where they generate the fees just planning Taiwanese investments in the world, because it has to be done trickily. They need the protection of a bilateral investment treaty, but they can't enter into them. They need a protection of tax treaties, but they don't have tax treaties, so they have to get around that, and so forth. Okay, so I've scrolled down to Article 4. So Article 4 will appear on screen in a moment. And there we have our resident Chinese expert providing your answer down in the chat box. Okay, so what have Brussels and Hong Kong agreed to? For the purposes of the agreement, the term resident of a contracting party means any person who, under the laws enforced is liable to tax by, well, that all looks very OECD-like. Now, remember, of course, China is not a member of the OECD. China could just as easily use the UN model. So let me, as we scroll down to our second sentence of Article 4 OECD style in our Brussels, Hong Kong thing. Let's go to the open another window in our model conventions. Let us scroll down to the United Nations, Model Tax Convention, Articles of the United Nations Model, Article 4. And for purposes of the convention, means any person, this term does not include any person who is liable to tax only by respective income from source in that state or situated therein. same as our OECD model. So what's going on here? Let's harken back. Let's see if I can do this. Where is my Article 4? Let's see. I have to wait till my UN model opens. Oh, I've got to reduce it. Okay. I'm waiting for my tax analyst to pop back up. Why? My tax analyst does not want to reopen. Let's see what's going on here. Maybe it's because this opened up. Okay, I'm going to have to open up a new tax analyst box. Databases. Maybe I had too many tax analysts opened up at the same time. Okay, one moment. No, I can't see my chat box. One moment. I have to use the chat box in the student view for a moment. Okay, I see Miguel has to go. Okay. Okay, I'm back at where I was previously. Model conventions. Scroll down to United Nations. Let's look at the 1979 United Nations Treaty. We're going back to Articles, Article 4, Residency, and we're going to discover something a little bit different. Article 4 for the 79 UN model, the 1979 UN model, notice it's missing the second sentence. There's nothing about sources from income in that state. So before I continue, let me just explain where I'm getting at with this. We have Belgium and we have Hong Kong. That's the treaty we're looking at. And it has the second sentence. But Hong Kong only taxes sources within its state. It does not tax income outside of its state. So is Hong Kong really entering into a tax treaty that, in essence, none of its own people can ever take advantage of? Is it possible? No, it's not possible. So I'm going to check something with my task manager because I have something's not working here. I see how my tax analyst is working, but my CPU usage is low. No, I don't know why. So, now it's back. Don't know why. Just is. Okay. So, now on your screen, you'll see shortly, you've just seen the UN model 1979. You will see now the UN model, the current UN model, from a few years ago. The current model has the second sentence. Yet, no nation that uses source as a test, as its test for fiscal jurisdiction, would enter into a treaty where all of its own residents, all of its own people, were excluded from it. It'd be a one-way treaty. Only the other countries could take advantage of the treaty. And if that was the case, then why would the source-based state ever enter into a treaty? Now, I can make arguments for it. Treaties are to prevent double taxation. And if it doesn't tax on worldwide income, there's a less likelihood of double taxation, but it does exist. The opportunity for double taxation, the source state-based company has income in the foreign state, but that income is deemed to be source state income also, double taxation. So no country that is source-based, be it Hong Kong, Singapore, Malaysia, be it many other source-based, France taxes on a territorial system its companies, not going to enter into a treaty with with the second sentence of Article 4 unless the second sentence doesn't mean what it appears to mean on the face of it. And so 2 weeks ago we discussed that what you read as a meaning, or 3 weeks ago we discussed when you see a term, the term doesn't necessarily mean what you think it means. One could start with the legal dictionaries and so forth, or even the common usage in society. But you read the word income, and it doesn't necessarily have it doesn't mean, by example, in the United States, scholarships. It doesn't necessarily mean capital gains, because those are taxed under a different regime, potentially. The United States doesn't necessarily mean Puerto Rico, U.S. Virgin Islands, but in some cases it does. And so it doesn't necessarily have the meaning you think it has a meaning. So where do I have to look? Text of my commentary. This is the UN model we're looking at right now, not the OECD. Okay, Article 4 of the UN Model Convention reproduces Article 4 of the OECD with one adjustment, namely the addition in 1999 to the criteria of place of incorporation. What? Place of incorporation? But we already saw with the OECD treaties, by reason of domicile, residence, place of incorporation, place of management, or other similar criteria. It's not dealing with the second part of the sentence, but just reminding us of our... Now I'm back to the OECD model, and we see it is a slightly different wording: domicile, place of management, or incorporation instead of place of incorporation, or then your criteria of a slightly different da-da-da-da. So slightly different wording. Okay, we go through why is it important, but let's get to the second sentence. And I'm highlighting the where we address that. So number 4, under paragraph 1, you'll see this on your screen in a moment, highlighted it. The OECD commentary observes, in accordance with the provisions of the second sentence of paragraph 1, a person is not to be considered, okay, that's a repeat. The situation exists in some states in relation to individuals, like foreign diplomatic. Well, that's not really going to be our case most of the time. The Spirit of Vision would also exclude the definition of a resident of a contracting state, foreign-held companies exempted from tax on their foreign income, to attract conduit companies. This has inherent difficulties and limitations. Thus, it has to be interpreted restrictively. Aha. So I've highlighted the answer to this little dilemma of Hong Kong signing a treaty that would exclude all Hong Kong companies and individuals from using the treaty. So it says, thus it has to be interpreted restrictively. Restrictively. Why? Because it might otherwise exclude from the scope of the convention all residents of countries adopting a territorial principle in the taxation. So everyone sees that on their screen. So both the UN and the OECD are going to say, interpret this restrictively. Now, there's another justification for extending residency status to territorial source-based countries. What's the second justification for this? And this is a very strong reason why countries might have tax treaties with Hong Kong, Singapore, etc. Singapore has lots of treaties. They don't have a problem. What's that second reason? It would, of course, from exchanging information about their activities. Now, they say the exclusion of certain companies from the definition would not, of course, they use. The tax treaty is clear who is subject to the tax treaty. Persons who are resident. Now, you see a conflict, and if we go to the OECD, we'll see the same conflict on if you have a second paragraph, and the second paragraph were to exclude the residents of Hong Kong and the ones who are covered by their source-based, then how can Hong Kong exchange information because they're not recognized for purposes of the tax treaty? They can't exchange it under the tax treaty. This is logical. But the OECD/UN is coming in and saying, would not, of course, like it is so clearly obvious. I think by the nature of them saying, of course, they realize the inherent illogical stature they're taking as regards to the issue of, if you were to exclude them on one hand, how can you include them on the other? You may or may not agree with my position on this. Simply, by restrictively applying Article 4, so that in the Hong Kong situation you cover these, its people, for purposes of the treaty, you moot this question. You may be able to exchange information via alternative vehicles. Mutual Legal Assistance Treaty, Hague Convention on the Collection of Evidence. There are other mechanisms for exchange of information. But my position is you cannot exchange it based on this treaty if the Article 4 second sentence is liberally construed to exclude these situations of source-based states and so forth. So in those treaties, so as you don't have a problem with exchange of information, and this is a justification for having treaties, full tax treaties with countries, and Marshall Langer will lecture on that in November and December. Those lectures have already been scheduled. Could you repeat the last point? The last point is, as a justification for restrictively interpreting the second sentence, and the second sentence works to exclude persons from being qualified as residents, that they may take advantage of the treaty. I say logic dictates that when you work through the treaty, that if a person is excluded from the scope of the treaty, then you may not exchange information pursuant to that treaty on that person. I think logic dictates that. Again, you may have another opinion, and that's okay. So to deal with that problem, they have restrictively. So there's two reasons they've dealt with it. One is a source-based state like Hong Kong would never enter into a treaty, like Singapore, like Malaysia. These countries that were source-based, France with its companies, territorial basis, would not enter into treaties with other countries. There'd be no interest for it because all their people would be excluded. But a second justification point for entering into the treaties is that for the exchange of information, you can exchange information on the parties that the treaty covers. And if the treaty excludes a party, then you can't cover information on it. And they spend this paragraph before talking about conduit companies and so forth, as if that's a bad thing. It's a good thing. It enhances capital flows between states. But if OECD/UN states want information freely moving exchanged, then they must restrictively interpret the second sentence of Article 4, i.e., they must not exclude parties just because they're tax on source from being able to use the treaty. And if they do exclude them, if they exclude them from one part of the treaty, then you exclude them from the other parts of the treaty. It's not some parts and not others, in my opinion. And the reason I'm saying that I think they see the same problem is because they throw in "of course," as if it's so self-evident, don't even question that there would be a problem. But then if it was so self-evident that one shouldn't question there should be a problem, then why state it is so self-evident one shouldn't question that there should be a problem? Anyway, I think it's intellectual honesty requires that they not use the word "of course." And they just stick with the being interpreted restrictively standard that I've highlighted under the green circle. So I'm going to drop my OECD and UN models down so that we can look back at the actual Belgium treaty. This is the UN. Where is my Belgium treaty? That is the UN. That is commentary. Yes, here's my Belgium treaty. Okay. So Belgium, Hong Kong maintains the second sentence, but the second sentence must be interpreted restrictively, i.e., it must be interpreted in such a way as to exclude, is to rarely or restrictively exclude parties. So what it does necessarily apply to is the situation of counselors for states, state diplomats. That's what the commentary tells us. The commentary says that this is about diplomats. Later it became about conduit companies, but it is not meant to exclude the residents of, or quasi-residents, since they're not taxed based on worldwide income taxation, but it's not meant to exclude the persons, i.e. also companies, of places like Hong Kong, Singapore, Malaysia, that tax based on source and territoriality. And that addresses the second sentence of Article 4. Now, South Africa was a source-based country until recently, and then they switched to Residency. And they had a discussion about that switch before the original switch. When the new government came in under Mandela, they discussed, should we have source or residency-based? And they had lots of opinions given to them, and they had a government commission, and they decided to stick with source-based because it's much easier to administer. And it would encourage capital inflows into South Africa, and there are many reasons listed. The CATS report, which you study in Principles of Taxation course of International Taxation, because the underlying analysis of why one has a source base or what a source base does, they're all valid. Then South Africa moved to a worldwide income taxation base because they need more revenues. And they wanted to collect more revenues, and but there are some trade-offs, so they've gotten less direct investment as a result. They anyway, that was and so they had more reports and commissions about that. Okay. Now, does anyone else have questions on Article 4? This first paragraph. Because the next lectures are going to have to be on tiebreaker, i.e. number 2, paragraph 2, and then finally paragraph 3. And we kind of talked about paragraph 3 last time. Management control. We certainly looked at that, and that has to be still. You still have to discuss some of the bull taxation or lack of any taxation or double loss concepts. I can't remember if we talked about double losses in the class or not. I know you and I talked about double losses, but there is the lecture on dual consolidated losses, DCL, dual consolidated losses. Look under your calendar, and there's the recorded webinar on dual consolidated losses. And if you weren't in class on Tuesday, I'll open it up now so everyone sees it. I placed it under the thesis course, and it's under your web links. In fact, we'll just go to web links. Under Westlaw Twin, we'll shoot to, doesn't matter, principles or the tax treaties course. I'll go to the principles course. I'll go to web links. And part 1 of October 7th is up there. You see the part 2 is there also with part 1, how to access the outside lectures. And that is referring to specifically, to make sure everyone understands, that we have the, we're sharing the lectures from Deloitte, KPMG, Ernst, Thomson Reuters, Butterworth's, Complinet, some other schools and firms. And so when we look at our calendar, we saw that, like on Monday, we had the live webinar on IFRS that went on for 2 hours. A lot of money to be made in that over the next 2 years. I mean, is a full employment act for audit firms and for lawyers to analyze the application. Full employment act. So you got 2 full employment acts right now. You got the new bailout employment act and the new bailout employment act. For those who saw yesterday, AIG had to come back and asked for another $40 billion, almost 37.5, on top of the $85 billion they already took. Shy. And you got $700 billion, but for those of you who caught the play, they're giving them another $300 billion. It's not part of the $700 billion. This is another $300 billion. And that was also yesterday, last night. The Petrus, from what I understood on tax treaties, there has to be a financial benefit for the state. The benefit from Hong Kong, well, the benefit from Hong Kong is clear. It should be the benefit for Belgium. The Hong Kong residents can now invest in Belgium and not have, let's look at the treaty, and not have withholding. There it is. So let's shoot down to some of the provisions on withholding. Let's look at dividends. Article 10. Dividends paid by a company which is resident in a contracting may be taxed in another state. We know that. So it's 5 or 15%, just like the OECD model. So what is the normal Belgium withholding rate on dividends? I don't know out of my head, but I can go look it up. So let's go pop open our, what resource should we use? I could use PricewaterhouseCoopers books too, because we got those under web links. We have as students, as long as you use your tgsl.edu password, you have access. So let's go to IBFD today, and we'll go to CCH. It's easier. I'm popping open CCH. It'll be on your screen in a moment. The reason I'm doing this is just so we can go see what the Belgian withholding rate is quickly. I click on the International Tax tab. I click on, by the way, some student asked me about Tax Notes International. There it is again. Well, obviously we have Worldwide Tax Daily, which is the same information, published daily as opposed to weekly. But here's your weekly Tax Notes International if you rather read the weekly, or the CCH International Tax Journal. Okay, so I'm clicking on International Tax Planning Manual. I'm going to click on Corporations, International Tax Planning Manual, Corporations. I'm going to click on Belgium. So I went to CCH, clicked International Tax tab, clicked on International Tax Planning Manual on the far right of my screen. I circled it in red. You'll see this happen on your student screen in a moment. I click on Corporations and then on Belgium. And I can go through the taxation of non-residents. I'll wait until my screen see what I'm looking at. Taxation of non-residents. I'll circle it in red. I've clicked on, so I'm clicking on taxation of non-residents. And I'm just waiting for it to appear on my student screen. There seems to be latency here. And I'm going to click on Table of Withholding Taxes. Table of Withholding Taxes. Okay. Now, I could have gone to IBFD, but IBFD takes longer to access the same information. I'm popping into CCH because it's a quicker resource. Doesn't mean that I don't go to PricewaterhouseCoopers books if I have those books available to me through the web link. Doesn't mean I don't use BNA foreign source country's income thing. And, there's many ways to get to the same information. I could just go to the Belgium website if I spoke Dutch or French. Quick. I always come to CCH. Domestic withholding rate in Belgium is 15 for interest and royalties, but I'm looking at dividends, 25%. So, and then I have a chart, Treaties in Belgium. So everyone should see what I'm looking at. And I would even see, there's my Hong Kong treaty mentioned. Okay. So I'm going to close that. And here we are, our Hong Kong treaty. And we see the maximum if it's a portfolio investment, which we've discussed before. It's 15%. If it's a non-portfolio, if it's a substantial investment, it's 5%. What is a substantial investment? It's at least 10% of the capital of the company. So if you own 10% or more of the capital of the company, the 25% from Belgium is reduced to 5%. So Hong Kong has a clear advantage. The real question is, what's the advantage for Belgium? Because Hong Kong doesn't withhold on dividends. Hong Kong doesn't withhold on it. Hong Kong doesn't withhold on da-da-da. So what is the advantage for Belgium? It may be political, like China will like us better if we do this. It may be economic. And Marshall Langer will talk more about that in his lectures in November and December. But if you look at the New Zealand UAE tax treaty, the New Zealand government published a report which said, why would we do a tax treaty with a tax haven? UAE didn't have any taxes. Why would we do a treaty? Economic. We need their money. UAE has a lot of money, $350 billion that could pour through UAE, or whatever the figure was. It was billions. And New Zealand said, in the report, the government said, we need the access to that money. And the only way we'll get the access is to have a treaty with UAE. Otherwise, New Zealand, as an investment opportunity to the UAE money, is less interesting relative to every other investment opportunity. And for those of you who sat in on the lectures 2 weeks ago, we talked about, and on the webinar last week, the 3-hour webinar I gave on valuation and so forth, all valuation is relative one investment to another. So New Zealand may be returning 8% in property markets, and if they're withholding on that of 25%, then you're getting 6% afterwards, or you have to take corporate tax into account and so forth. But let's just say 6%. And then let's say that Australia is returning 7%, no withholding. Well, then all the money goes to Australia, New Zealand's out, absent some desire to mitigate risks across countries. But if the deciding factor is investment return, which it is for many funds, then New Zealand's out. So New Zealand does a tax treaty with UAE. So why would Belgium do a tax treaty with Hong Kong? Because for Hong Kong, the benefits are obvious, as long as the second part of the first paragraph, the second sentence of the first paragraph, does not exclude Hong Kong companies from utilizing the treaty. So now that they've worked that one out, that it really only applies to diplomats and others, Hong Kong has a clear advantage. It reduces dividend withholding from 25 to 5. Belgium, on the other hand, their justification has to be exchange of information, because when we scroll down, if there's no treaty in place, Hong Kong perhaps doesn't recognize any exchange of information with Belgium. And maybe Belgium wants information on Hong Kong companies that may be, for whatever reason, subject to tax, or their owners, beneficial owners, yada yada, subject to tax in Belgium. And Hong Kong may be smarter than the islands in the Caribbean in saying, we're not doing a tax treaty with you unless it's a full tax treaty. If you want a TIEA, Tax Information Exchange Agreement, come and talk to us in a decade, or this is going to be a slow process. What are you going to do? You're going to stop sending us tourists? Full tax treaty or nothing. Now, the Cayman Islands and Bahamas may feel that they can't get, and that Hong Kong can get it because Hong Kong is a financial center. But anyway, Marshall Langer will discuss that further. He's always said no TIEAs, full tax treaties. Hong Kong did that, and so perhaps Brussels signed this for that reason. I'm sure that there are government reports in Dutch or French on that. I just haven't looked because I don't care that much. But if you're interested, you have all the resources available for finding it, whether it's on the government websites or through the numerous databases that we subscribe to you for. You'll see on Article 11 and 12 for interest and royalties, it's also reduced, the withholding. So it's clear why Hong Kong did it. For Brussels, we'll have to go search. Okay, I see Petra says thanks. Any other questions on the first paragraph of Article 4? No. Well, I'm going to have to go down to the IT department again all day. As I said, we're instituting our new systems and making them more trained and so forth. So I'll stop recording, and